pretty shockingly bad downgrade, high, down to 4.9% growth for the global economy this year. Just April, you were projecting a 3% slide. What changed so much that made you so much more pessimistic about the world economy?
I think there were a couple of reasons. One is that the first half of this year turned out to be somewhat worse than we anticipated in April. In many countries, the period of the lockdown was extended. And going forward, we expect to have much more persistent social distancing because the health crisis is not over. And that's going to have an effect also on potential growth. So these factors led to the downgrade.
Let's talk about the U.S., which you see a pretty sharp 8% contraction for the year in terms of economic growth. And then in 2021, only growth of 4.5%, which dashes a lot of hopes that people have in the market about a V-shaped recovery and claiming back all the growth that we lost. Why don't you see that happening?
So, Sarah, we're projecting a very big hit to the second quarter GDP growth. I think about minus 45% annualized. And then we have a recovery after that. But, it's hard to make up that big hit. And even if you look at 2 years later, so by end 2021, for the U.S. numbers are still below the pre-crisis levels. So we are expecting a slow recovery. I mean, there's been good news on the employment front, but at the same time, if you look at the unemployment claims, the level at which they are, and that they remain quite steady at that level, tells you that this crisis will play out for much longer.
Do you embed an idea that we'll get a vaccine at some point, whether it's before the end of this year or early next year, in the way you forecast the economy?
So in the baseline, we aren't putting any date on the vaccine, but on the baseline, we're assuming that through a combination of measures, some of which would be just, people practicing social distancing, wearing masks, offices being rearranged appropriately, that we might see some increase in infections, but we will not be seeing the kind of stringent lockdowns that we saw in the first half of this year. The question is, of course, whether we might have a big second wave. And we have looked at that scenario, which is what if there's a big second wave. Now, that's a case where global growth is going to be then pretty much close to zero in 2021, as opposed to 5.4%, which we are projecting now. But again, there's tremendous uncertainty. There could also be an upside, which is that we could have better news on treatments and vaccines, and this recovery could be even faster than what we're projecting.
There is a theme that runs through this, which is the developed world is going to get hit harder than the emerging world in terms of growth this year. Do you chalk that up to the fact that the virus response policies have been better elsewhere, or what is actually causing that?
So, Sarah, actually, if you look at the size of the downward revisions we've done for emerging markets relative to advanced economies, and if you take emerging markets and you exclude China, that downward revision is actually bigger for emerging markets as compared to advanced economies. So in April, it was indeed the case that was reversed, but that was because the health crisis hadn't spread as severely to emerging markets. But now it is there. And in fact, the pandemic has shifted to Latin America, and many emerging markets are seeing rising cases. So, yes, we actually do have a bigger hit. And also it's important to keep in mind is that when you take a country with lower per capita income getting hits of this kind, that's a big increase in poverty for these countries and for the world.
Policy response. They've been robust around the world in terms of central banks and from governments. Do we need more stimulus in this country, in the U.S.? And if so, where should that specifically be targeted?
So, we're not out of the woods. We don't have a solution to the health crisis. And so substantial support will need to be continued. Now, what form it particularly takes is going to depend upon how the recovery goes going forward. So if there is a stronger recovery and we are seeing stable improvements, then in that case, you can see a switching of incentives from keeping people at home to actually encouraging them to return to work. And also now allowing workers to reallocate from sectors that are shrinking to sectors that will grow, because we expect to see this kind of sectoral reallocation going forward. But substantial support will be needed both on the fiscal side and on the monetary side. And also keep in mind that, while there's a real crisis, there is no financial crisis, and that's come about because of substantial support from also major central banks in the world. And that is a risk about, suppose we have bad news and we trigger a tightening of financial conditions. At that time, again, there would have to be further stimulus that will have to come in.